Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is investing in dividend stocks. And there have been some interesting developments for dividend investors recently. A little bit of weakness in that corner of the marketplace, but I wanted to talk today about why the phrase buy the dip may have even more weight for the dividend investor. We're going to be weighing the pros and the cons of that approach and applying that to current market conditions. It should be an interesting discussion. Before we get to any of that, though, let me first of all say hello to everybody who's chatting in out there in YouTube. Great to see all the familiar names. If you're here for the first time, welcome. But hello there, Olga and JV Texan, Richard, Rojo, Life in the Fast Lane, Jack, Eva. Who else was out there? Let me scroll up here a little bit. We also have Long Snapper. Great to see you. Everybody else, thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, welcome. Great to have you on board. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy that recording. That's a great way to watch these webcasts, but be aware that you are invited to join us in the live stream if you'd like to be here. This is a Thursday webcast series. We kick things off promptly at noon Eastern time. Now, I also want to let you know that my very good friend Brent Moore is hanging out in the chats with us today. Brent's keeping an eye on any questions that come in, and if I can't get to those, he's there to pick up my slack. Thanks for having my back there, Brent. Now, Brent and I would also like to issue an invitation to all of you watching, anybody listening. The best place to connect with your favorite presenters in between the live streams is on social media. So follow us there on social media. You can follow Brent and me on X. You can find Brent there at Brent Moore CS. You can find me on X at Cameron May CS. And a matter of fact, I just reposted something that Brent posted yesterday that I think is going to be pertinent to today's discussion. So yeah, very good place to get maybe additional information when the cameras aren't on. But you can also now follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion. Talking about buying the dip from the dividend investor's perspective. Before we do that, though, of course, there are risks associated with that approach. So bear these disclosures in mind. This material is intended for general informational educational purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so here's what we're going to be doing today. The agenda, we're going to take a quick peek at what's going on with our current example paperMoney portfolio, do a little portfolio checkup. We're not going to be making any changes to that portfolio, just so you know, aside from adding a new position. Then we're going to be taking a look at what's going on with the markets. And as I mentioned, there's something that's interesting going on with bonds, something interesting going on with dividend stocks. And I wanted to talk about potential implications of those movements for a dividend investor out there looking to invest in something new. So we're going to be talking about how a pullback may present that opportunity for a dividend investor to buy dips and how that may be associated with two potential benefits. Now, obviously, it's not a guarantee, but we're going to look at those market conditions, and then we're going to do a quick scan for a dividend stock, find a new example investment. I'm going to do a little weighing of the pros and the characteristics of two potential stocks, and just have you help me pick one to be added to our example portfolio. So a lot on the docket. Let's get into it. Let's go right to the thinkorswim platform. Here are our current positions. We have 8 dividend stocks across a range of sectors. I believe we have 6 sectors represented. Let's see, we have 2 in utilities. We have, what else do we have a duplicate of? Anyway, yeah. Number of sectors represented, maybe 7. We're going to be adding a sector for additional diversification today. But in any case, right now, an average S&P 500 component dividend-paying company paying about a 1.15% yield. I think our portfolio average yield is closer to 3.6% at the moment. Our beta, with just one exception, all positions are below 1 with a beta. That's an indication of lower volatility. Certainly volatility can pick up, but at least on average over the last 5 years, these stocks have been a little bit less volatile than average. We're keeping an eye on the dividend payout ratio, making sure that not too much of the income is being directed toward dividend, not obligations, but let's say board commitments. In any case, we also are looking at long-term debt, trying to keep that ratio comparatively low. For dividend investors, they sometimes see debt as a threat to the ongoing collection of those dividends. Now, a final thing that we're keeping an eye on here is the performance. And KMI just keeps going for us. KMI is up 22% in just the last several weeks. BG doing well, up about 12%. Overall, our portfolio is up about 6.2%. We just started this portfolio at the start of 2026. It's now the middle of March, so about 2.5 months. We've been in an average position for about 5 weeks. So overall, portfolio is doing well. That's largely because it's been a cooperative environment for dividend investors. It hasn't been terribly good for stock investors in general, kind of a flat marketplace for investors in general. But maybe there's been a little bit of a retreat to quote unquote safety. Safety is a strong word. Nothing that we have here is inherently safe, right? But for some investors, when they feel maybe a little bit less of an appetite for speculation, there may be a rotation generally of cash toward, let's say, dividend-paying companies. And this may account for why we've done so well to this point. But it's a little bit of a different scenario at this moment. Let's go see what's going on with the marketplace, all right? Now, as we do, I will say, if KMI continues to grow like this, we may need to trim that back sooner than anticipated. I didn't know if we were even getting an opportunity. I still don't know. But we will be doing some rebalancing in this portfolio if it becomes apparently necessary. And the tipping point there will be if one of our stocks that when it was purchased represented 5% of our portfolio, if that grows to be more than 8%, we're going to trim that down. So Barbara says the target to have from stock from each sector. Yeah, Barbara, so what we do here is just 5% of each investment, or 5% of our portfolio is committed to each investment. And really, unless there's a dividend cut, or the company starts to take on a ton of debt, something like that, we're probably not going to be making changes except to rebalance. So we will rebalance if one of our positions grows to be disproportionately large in our portfolio. We will also rebalance if one of our positions shrinks. So if it goes from 5% to under 4%, we'll probably add to that position. Now, those are just examples of how a dividend investor might manage a portfolio. But what we're not going to be doing in this webcast series is trading. We're not going to be looking at stock charts and saying, oops, we broke support, we're selling. Nope, not doing that kind of stuff. But let's go to the markets and let's see what's going on. So here's what I noted, and this is tied to the post that Brent made yesterday, I think. All right. But TNX:CGI is a chart of the yields on 10-year bonds or 10-year treasuries. And right now they're at 4.249%. We just moved that decimal one position to the left. That gives us the general yield. Yields have actually been coming up on those longer-term government debt instruments. You can see just as recently as a couple of weeks ago, 10-year bond yields were down around 3.95%. Now they're up 4.25%. So up fairly substantially in a relatively short period of time. And that may be because investor sentiment is turning a little bit, or appears to be turning away from near-term cuts to the Fed target rate. Yeah, so when the Fed is holding those rates steady, sometimes we'll see these yields climb on these debt instruments, start to go up. So yeah, yields are going up on bonds. Now what that can do is it can tip the scales away from dividend investing for a period. And we're seeing that on a chart. Now, one thing that I wanted to call out right here, Brent, I really like that post you made yesterday, because it called attention to precisely this. Let me go to let me go to that post. And I also want to encourage you again, if you're not following us on social media, do that. You can follow me right here at Cameron May CS. But here's Brent's post from yesterday. The March Consumer Price Index report was released this morning, showing that consumer prices rose as expected. So where was the CPI yesterday? 2.4% year over year. That's inflation of 2.4% basically on consumer goods. And that's a little bit ahead of what the Fed is projecting. Now, consumer goods is kind of oversimplifying things. Anyway, yeah, as a measure of inflation, it's about 0.4%. That's fairly substantially ahead of the Fed's stated goal of 2% inflation. So that may indicate to investors that the Fed is less likely to cut interest rates soon, because cutting interest rates tends to have an influence of spurring inflation. So yeah, while the data didn't offer any disinflation surprises, it confirmed the Fed is unlikely to cut rates soon. Consequently, what? Treasury yields are ticking up. Yep, there they go. So bonds strengthening. So there's some good information that can be had if you're following us on social media. We try to keep you sort of aware of these kinds of developments. But what's the impact on our dividend investors? Well, let's bring up our S&P 500. Actually, let me go this way. Rather than typing in the symbol, SVIDMD is the sort of the phrase that I use. Let's go to our recent symbols. This is a quick way to find our, right there. There's our Dividend Monarchs Index. If you're not familiar with this index, so again, $SPHYDMUT is the symbol, but this is a chart that some dividend investors will use to keep a general gauge of how other dividend investors are doing, maybe including themselves. But specifically, this tracks the total performance of the dividend monarchs. Those are companies that are part of the S&P 1500 that have been paying dividends for at least 50 years. All right, but in any case, the dividend monarchs have been having a nice run, stretching all the way back to the first part of November. But look what's happening right now as yields on long-term government treasuries are increasing. The performance of dividend bonds or dividend stocks has been coming down. That's because theoretically there's only so much cash that income investors have to spend. And if bonds look good, maybe they redirect some of that cash away from dividend stocks. So that really seems to be the model that's playing out right now. It's not a guarantee that that's exactly what's happening. But here we have a sell-off. Now, some others may describe this as a dip. All right. Have we ever heard that phrase, buy the dip? Dividend investors as a group are probably not really known for using charts and trying to refine their timing down to the level that, let's say, a trader might. However, they may see, if they're going to buy a dividend stock anyway, they may see a little sell-off like this as containing a potential double benefit. Number one is they may be able to buy stocks at lower prices. They were already going to buy them anyway. Are we looking to buy at high prices or low prices? Probably low prices, right? Now, another thing is, what happens to dividend yields when prices come down as long as the company hasn't just cut the dividend? Well, very likely, we're getting a lower basis. We're getting a higher yield on our stocks compared to if we compare that to the annual dividend rate that's being paid. In other words, the yield that's received. Yeah, possible double benefit. Now, of course, there's risk. Could this rotation away from dividend stocks persist? Could it go on? Yeah. And so there is market risk for stock investments. But there's, as a consolation here, the dividend investor may just say, well, I don't care about the fluctuations of price. I'm just getting stocks at least a lower price than they were available recently. What I'm looking for is the yield. That's right, Eva. Higher yield on cost, YOC, when prices decrease. Yep. All right. So this is actually going to be the motivation for today's discussion. It's going to be twofold. Number one, we have sort of inflation in the back of our minds. How might the dividend investor bring that into their selection process? Is there a way that they might hedge against inflation? Now, a second motivation is just going to be to buy the dips, right? So let's go over to the sectors. And previously, I've shown you how to find a watch list of the sectors. Very quickly, if you don't have it already, you can just go up here to the watch list heading, go to the public watch lists, and you can find the S&P 500 sectors right here. So there are our sectors. And I've also added a description column. We can do that by clicking on the little gear icon, customize, and just choose description right here and add it. But I wanted to look at the materials sector. Let's see, Barbara says, wonder what the total average dividend aristocrat stock has paid annually over the last 5 years. It's an interesting discussion, Barbara. I haven't specifically investigated that, so I couldn't tell you off the top of my head. But I mean, we could, as sort of a surrogate for that, just look at the dividend monarchs here, because the aristocrats, there's a whole lot of overlap between the monarchs and the aristocrats. I don't know what the percentage is. I would guess it's probably north of 90 or 95%. But in any case, we could just look at, let's say, a total return chart by switching to a longer term view right here. And if this is what the monarchs have done, it's quite likely that the aristocrats have done something very similar. All right, so back to the sectors, though. I wanted to give a little bit of attention to materials today for a couple of reasons. Number one, we don't own any materials stocks in our portfolio. And number two, materials are sometimes seen as a potential hedge against inflation. Why is that? What is inflation? Isn't it the price of stuff going up? That's, I think, that's an oversimplification again of the concept of inflation, but I think it's actually serviceable. So if the price of stuff is going up, what is materials? Materials is actually investing, generically speaking, in stuff. So if the price of stuff goes up, materials may benefit from that as well. It hasn't recently. Just so you know, that sort of assumption doesn't always play out. Here's what's been going on in the materials sector. Over the course of the last couple of weeks, materials stocks have actually come down about 10%, largely in step with what's been going on with dividend stocks in general. So for that dividend investor who might be seeking, let's say, additional diversification in their portfolio, possibly looking for at least a theoretical hedge against inflation, but who's also looking to buy the dip, this may serve all three of those objectives. Now, again, there's certainly market risk. Yep, this could continue to go down, but at the very least, our would-be dividend investor might be able to say, prices are about 10% lower than they were a couple of weeks ago in this sector in which I don't have any representation in my portfolio. And yields are likely to be higher as a result. So what I want to do, how about we look to add to our portfolio from that materials sector? Let's see. Evie, you have a favorite in the materials sector? Okay, so you asked, how do we find if a stock is in a specific sector? So here's a quick way. If we want to confirm that, we can go to the Analyze tab and go to the Fundamentals page and type your symbol in here. So I'm not going to use the stock that was proposed, but we can just type in our symbol here. Sometimes for whatever reason, I've noticed this about Disney. You probably didn't catch this. You can see it on the recording, but when I first loaded up, the sector didn't load. I probably was just a little bit impatient, but typing in another symbol and coming back to it kind of refreshed it. But this right here can tell us what sector. a company is in. That's just a quick way to like check it when I'm on thinkorswim. If I have a company and I think, what now, which sector is this in again? It's right there on the fundamentals page. Yeah, Long Snapper says you can also Google it if I want to do the very obvious thing and not try to look cool just by saying we can also do it on thinkorswim. Yeah, very good point. Anyway, but back to our chart, not Disney. Let's go back to materials. How about let's run a scan in the materials sector. Let's find a couple of potential investment candidates from that sector, maybe something that's pulling back but performing relatively well over time. And let's pick one for our portfolio. Paul says you have a sector in watch list. Yep, you can do that as well, Paul. But in any case, let's do that. Now, before the webcast started, I cheated. I built the scan. I ran it because every once in a while, I want you to feel my pain here for just a moment. As an instructor, sometimes when I'm running a webcast and I try to conduct a scan at the same time, it puts kind of a drag on my computer's bandwidth. It can slow things down. And so I have to sit here in some uncomfortable silence and wait for the page to load. So I wanted to be prepared for that. So I ran this in advance, just in case that happens. I don't know. But here is a scan that I've constructed just as an example for that investor who might be looking for dividend stocks in that materials sector. So what I used as a baseline for this is my dividend working class, if you were here for that discussion, my dividend working class scan. Let me do this. I'm going to post a link to that scan in the chat. Go. Let me post that in the chat. I'll also, for the benefit of those that are watching on the archive, I'll just post it down below. So you can just look at the video description underneath the video right now, and you'll find that link down. It'll just say, here's my dividend working class scan, and have a link. You can click on that. Not click on that, but load that into the platform. But when I share one of those links, just for those who aren't familiar with thinkorswim, you take that link right up here, the little gear icon, click on that and select open shared item, pop the link in here, click preview and import. And what that does is it imports that scan into your personal scans. So if we want to load it up, we go right here, go to load scan query, our personal scans, and we'll find it right there. All right. But in any case, I thought what we'd do, now that I've already cheated and shown you the 6 companies that result from this scan, I'm going to show how to build it from scratch. Let me do this. I'm just going to hit reset right up here because it's a little bit of a cheat for me to just say, here's a scan, run it. But here's the concept. We're going to be looking in the S&P 500, specifically within the materials sector. So we're going to intersect with the materials sector and just select all materials. And then within that, let's talk about what an investor's priorities might be. Now, we have example priorities in this webcast series. So let's list those out just quickly. If we're out there looking for a dividend investment candidate, what exactly are we looking for? Well, number 1 would be the yield. Yes, we're looking for dividends. Number 2, and just so I don't miss anything, I'm going to bring up my session notes off to the right, so I don't forget anything in this list. It's important to get it all. We do emphasize diversification in this discussion. Not everybody necessarily cares that they have every sector represented in their portfolio, but to some, in their efforts to minimize portfolio risk, they may choose to spread their investments out across a range of sectors. So diversification is a priority in this example webcast. We're also looking for consistency of dividends. There are a number of ways that might be confirmed. Just remind me, if I don't do it, to take a look at the dividends on our long-term chart and we can just do a quick spot check of that consistency, make sure that our company has a good track record of paying a dividend, but also increasing that dividend over time. Number 4 is debt. For some investors, they see high levels of debt as a risk to a company's ongoing ability to keep paying a dividend. Number 5 is the volatility of the stock. Highly volatile stocks can be kind of an emotional roller coaster ride while we're just waiting for our dividend to be paid. And for some investors, they'd prefer to avoid that. Number 6 is net performance or total performance. Dividends are great, but not great if we're making 3% annually while watching our stock fall 10% annually. So the net performance of price plus dividends is an emphasis in this series. And finally, for some, the payment schedule. We'll keep an eye on this. We don't always completely emphasize it, but for some dividend income seekers, what they may choose to do is if they have 2 candidates to be added to their portfolio, and one's paying a dividend in a month when they already have lots of dividends, and the other one is paying a dividend in a month when they don't have a dividend income or less of a dividend income, maybe they might favor the one versus the other, all other things being relatively equal. So those are our example priorities. Let's see if we can narrow our field of candidates down using our scan while addressing these priorities. All right, so yield. How about we put that in first? And bear with me for just a moment. I just have to move things around on my side screen here for just a second. Anyway, let's go down to yield in our default stock criteria column. And with the average S&P 500 component company paying a yield of about 1.15%, how about we just set a minimum of 2% here? Let's see, I think I have that as narrow as I can. Yep. And a maximum, let's put in 6%. Not 8, 6%. A very high yield to some investors may represent risk because a company that's trying to pay great big dividends every year, they might struggle to do that. That could be a tough thing to achieve year after year. And cutting a dividend can be harmful to the stock's value. Typically, it's not well received. So let's put a cap there at about 6%, just as an example. Next up, the size of the company. We're looking for volatility, possibly consistency. Typically, the size of the company can be strongly correlated with both of those. Larger, more stable companies, not every large company is stable, but as a group, generally larger companies have a more stable business model. They may be more able to continue paying a consistent dividend while maybe being exposed to less stock volatility. So how about we say we want a market capitalization of at least 10,000 million or $10 billion. A next scan criteria is going to be a direct volatility metric, and that is, let's put in our beta. I'm going to put a beta of 0.5 to 1.5. If you're not familiar with beta, this is a gauge of volatility as measured against the S&P 500. And if a stock just tends to do what the S&P does, we would say that it has a 1-to-1 relationship with the S&P. Or in other words, it's about as volatile as an average stock, and we give that a beta score of 1. A stock that's less volatile is going to have a beta below 1. A stock that's more volatile is going to have a beta above 1. So let's let's center our beta sort of around average. To 50% below average will be our low end. 50% above average will be our high end there. Now, as a final filter, let's put in a debt requirement. Let's come up here and select Add Filter. I'm going to choose a fundamental filter, and we're going to go to long-term. Where do we go? Long-term debt to capital. This is just comparing a company's long-term debt that they've acquired, maybe to finance growth opportunities or whatever their motivations might be for taking on debt, well, how much do they have in other capital resources other than debt? So we take long-term debt, we add in common stock and preferred stock, divide that by debt, or divide debt by that, and that gives us our percentage of capitalization represented by long-term debt. Let's just put a 50% cap as an example for that. Eva says you're getting error in chat. Try again. What does that mean? I don't know, but it looks like your messages are getting through. Sam says that's a good screening tool. The beta, at least it's a gauge of historical volatility. Yeah, and so for our investors who are looking for maybe a smoother ride, if history is an indication of what the ride might be in the future, using a comparatively lower beta score might assist with that. Yeah. Right. Let's see. Kalia says, please advise how to schedule an online meeting. All right. Yeah. Just call support at 800-435-9050. But let's run this scan. And this is where I have my fingers crossed, because sometimes, yeah, when I run this scan, there we go. Look at that. Bang. Looks like one other company might have just slid in. Probably one of these metrics just shifted. But these now 7 companies, we know some things about these. They're all in the materials sector. We can see that right here. They have a dividend yield of at least 2%, not exceeding 6%. These are big companies. Market capitalization's over $10 billion. Beta between 0.5 and 1.5. Debt not exceeding 50% of capitalization. So let's compare a couple, and let's add one of these to our example dividend portfolio. And the 2 that I've selected, and I'll tell you the reason why I selected these, we're going to compare APD against PKG. So we have Air Products and Chemicals and Packaging Corporation. If we are looking at a company, I would suspect there are some of you who are going to say, okay, these are S&P 500 companies, but I've never heard of them. I don't know what they do. Maybe their corporate names give away some of what they do. Well, this is where you might want to go to the Analyze tab. Let's go back. Let's say PKG. We can go to the Analyze tab and type in PKG, and this will just tell us what the company is. Packaging Corporation of America manufactures and sells containerboard and uncoated free sheet paper products in North America. And we can read the rest of this. Looks like it was founded in 1867. It's headquartered in Illinois. Okay, so we can read through that. If we're trying to learn about a company, we can also see lots of other fundamental data down below. But I want to go back to our scan tab, and let's just look at, let's just do a sort of a high-level comparison of APD versus PKG. And then we're going to go look at their charts. All right, and what we're looking at on the chart is the long-term total return of price plus dividends. There are some of these materials companies that are paying relatively strong dividends, and yet you throw price into the mix, and these things have just been suffering for years and years and years and years. They've not been productive for their investors. So that was why I narrowed into APD and PKG. Now, as we know, history is not a guarantee of what's going to happen in the future. But for this series, in this webcast series, we do check that long-term total performance. All right, but overall, let's look at APD. Dividend yield around 2.9%. Long-term debt about 50, just a shade under. Market capitalization, it's a big company, about $64 billion. Now, if we compare that to PKG, a little bit lower yield, slightly less debt, kind of a smaller company. Both of these S&P 500 component companies, both of these paying more than double the average dividend yield. You look at this number, it might not look huge to you, but it's pretty big in the context of the broader markets. Now, here's the final thing I want you to look at. Let's go look at the long-term total return charts. Here we go. Let's go to charts. Let's hide this left column. We don't need that anymore. And we have, here's PKG. Packaging Corporation of America. And I'm going to switch this to a 10-year weekly view, but I'm going to make one change to this chart. Right now, the chart is just showing, I believe, let me just double check, make sure I didn't leave something. That's not what I wanted to click on. Let me go to the little gear icon. I'm going to go to equities. Yep, that's good. So I've seen what I needed to see. But right now, this is showing us what Packaging Corporation of America's stock has done over the years. So 10 years ago, it was a $55 stock. Now it's $220 stock. That's a 4x performance for price. But all along the way, it's also been paying dividends. So 10 years ago, it was paying a 55-cent dividend. Let's do a little spot check. That grew to 63 cents. It then grew to 79 cents. So what I'm doing is just pointing my cursor at the little green dividend icons. And what this is confirming for me is that at least over the last 10 years, there's a growth trajectory to the size of the dividend being paid. 79 cents grew to $1, then to $1.25. What's it most recently? What was the most recent payment? $1.25. So it's been holding steady for a couple of years here, maybe through some of this choppiness. But in any case, over the long term, the dividends have been growing on this stock. But what I wanted to do is combine price plus dividends. I want the chart to show both of those. So here's how we can do that. We can go up to our chart settings, go to equities, because stocks and equities is kind of a similar, kind of interchangeable terms there. And we're going to, right here where it says adjust for dividends, if we change this to all, what this does is it adjusts the chart to include the dividends that have been paid over the years. So you might think that, well, isn't that already there? Well, not exactly. Let me click apply. And what you'll see now is instead of this looking like it's starting at $55, why are we down below 20 now? It's because this is now showing us the growth, including dividends. On a traditional stock chart, it only shows price. And every time there's a dividend paid, that dividend is actually removed from the price performance. This is just building that dividend back in. So overall, here's the performance of Packaging Corporation of America. This is total return, price plus dividends. So let's look at how APD has done over that same time frame. Here's Air Products. Including dividends, we've gone from a net value of $80 10 years ago to about $280 today. So both of those have done very well. PKG has clearly done better, but that's not a guarantee of what the future holds. There's another thing. Robin says, is there a way to compare the two charts? Yes, there is. I'm not going to be doing that today, but you can do a comparison chart right up here. It's one of the chart tools. Just look for comparison. Mahesh says, thinkorswim has so many features, doesn't have a way to bring up a graph of the dividends below the price chart. That's an interesting question. I'm not aware of something like that, Mahesh. I'll do a little bit of digging. I don't think I'm going to find anything along those lines, but it's an interesting concept. Yeah, Sam says the little green dots tell us the dividends that are paid. But Sam, I think what he's saying is, can't we just like take, so our first dividend here was 86 cents and the next one was 86 cents. You add those two together and maybe you could just see how much in aggregate dividends have been paid over the years, just displayed as a price chart. Is that what you're talking about, Mahesh? Yeah, that'd be interesting. Rick Casey says, can you compare them to the S&P? We could do that using the relative strength. So I want to get into that, then I have to explain that. Unfortunately, we don't have time. I only have a couple of minutes to wrap up my comments and then to wrap up the webcast. But in any case, let's throw it to a vote here. Let's take one last good look at APD. Think about those fundamental metrics that we reviewed: debt. Well, I can just go back here over here to the scan. Here we have our yield, we have debt, we have market capitalization. These are all in the same sector, so that's not going to be a deciding factor here. But there's APD, and let's look at PKG. And just chat in, and the first symbol to get 3 votes is the one that we're going to be adding to our portfolio today. Okay, so we have it. Our first vote is in. There's a second vote coming in. PS says there is a dividend coming up for APD. Yep, there's also one for, if you want to talk about timing, yeah, the dividend for APD is, or for PKG, APD, yeah, is tomorrow. That's the ex-dividend date, so we'd have to buy it today to get tomorrow's, to qualify for tomorrow's dividend. But PKG is paying a couple of weeks, so it's not like a huge advantage. And by the way, is it an advantage to buy right before a dividend payment? Not theoretically, because price is adjusted for that dividend. All right, looks like we got lots of votes for PK. It's pretty much unanimous. Just everybody shouting for PKG. So let's add PKG to our portfolio. One other thing, I'm kind of glad you chose PKG, is because the point here was to buy on a dip. And you'll notice with PKG, there has been that recent dip in price, about a 10% dip right there, maybe a little bit more. But you compare that back here to APD. APD actually has been climbing recently. So it kind of makes my point a little bit stronger. So let's go for PKG. We'll go to our trade tab. Let's do a quick calculation as we type in our symbol here. This is a $220 stock. We invest $10,000 in each stock, so we have $10,000. Divide that by 220, and that means we're going to be buying 45 shares. So let's go to the ask price. We'll click on that. Let's adjust the quantity to 45. I'm going to submit this as a market order. Obviously, when we submit a market order, there are risks. We may not be thrilled with the price that we pay. I said 220 bucks. Looks like it's going to be a bit more than that, but we're not even guaranteed 220 and 74 cents. It just, we get what we get here with a market order. But looks like we're going to be around that $10,000 limit. Let's send that order off. No commission on this investment, but it can be on some types of trades. And that should fill pretty quickly. Here's our working order. We have that market order in. Bought that for $220.67. All right. So we now have materials represented in our portfolio, and that is a sector that some see as potentially an inflation hedge. Obviously, it can go down even if inflation goes up. But we'll see how this one performs. It's now in the portfolio. We've expanded the diversification of the portfolio. Thanks for your assistance with that, guys. Time for me to let you go. But as you do, I want to give you a couple of reminders regarding the big slate of educational offerings from Schwab Education. Make sure that you are aware of all of them and you have the ability to take advantage of Schwab Education. Number one is, if you're new to these webcasts, welcome. It's great to have you, but make sure that you've subscribed to our Trader Talks channel on YouTube. So the full name here is Trader Talks Schwab Coaching Webcasts. Yes, we have trading, but we also have investing webcasts, and you can join them live right here. You can also find playlists right there. So pop down below the video, click on the subscribe button. It only takes a second, doesn't cost anything to do that, but this is where you can find these webcasts. Also, I want to invite you to follow us on social media. As you've seen from this demonstration, Brent and I are both very active on social media. And you can find and follow us both on X. So you can find Brent on X at Brent Moore CS. You can find and follow me at Cameron May CS. And if you reply to our posts, like if you give me a reply to this repost from Brent, I just try to reply right back to you, and it allows for conversation when the cameras aren't on. Now, you can also follow me on LinkedIn as of just a few months ago. So you just go to linkedin.com/Cameron May CS, and that's where you'll find me. But guys, I really enjoy this Thursday webcast series. I like talking about investing, the longer term. So I hope that you'll put it in your calendar to join me again next Thursday. Now, I have other webcasts every day of the week. As long as the markets are open, as long as I'm not on vacation, I have something going on. So keep an eye out for my other webcasts each day. I'll look for you in those. Brent, thanks for helping out in chat. Didn't see a survey, but if you do see a survey, make sure that you fill it out. That's always appreciated. But I do see 136 people watching the live stream right now, and it looks like 56 have already clicked the thumbs up button. That's very much appreciated, everybody. It definitely helps every time you click. It's like a pat on the back to your presenter, but it also gives my video a nice little boost in the YouTube algorithm, helps more people find these discussions like investing in dividend stocks. All right, have a great day, everybody. Go enjoy the next webcast. I will see you in a future webcast. I will also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.